I'd say the first step is to educate yourself in what the process looks like and what you can actually do within your specific situation. Because if you just became self-employed, you're going to have a large down payment because you're not going to be able to qualify for your traditional conventional FHA type of products unless you've been self-employed for 2 years or 1 year in certain situations. And then if you're new to just graduating from college and you have a job offer, then you're in a different position than that other person. And you may need to just pay down your credit cards to see your credit score jump up.
You're checking out the Investor Shed podcast with Nick Beveridge and Jeremy Kitchen. They're on the path to financial freedom and they're taking their community with them. Stay tuned for the best free real estate investing advice on the internet.
Everybody, welcome back to the Investor Shed podcast. We're so glad you're here. Here with my co-host, Mr. Fire, Jeremy Kitchen. How are you?
We are on fire today, ladies and gentlemen. It is bright and hot under these lights. Speaking of bright and hot under the lights, so we have Andy Byrd on the podcast. Nick, tell us about Andy Byrd.
Andy goes by Andy or Andrew, and he will not tell you which one he prefers.
He won't. He says either will do, but I like calling him Andy.
Yes. So I like to spice it up here and there. Emails, I prefer to say Andrew because that's what my auto completion does. But I'll call him Andy in person.
Yeah, he does not like to go by Andrew Negus, though, so don't call him Andrew Negus. Andy's a great dude. He is a mortgage lender with Willamette Valley Bank. He's also a real estate investor. I love the way he invests, by the way. Like, that's the type of investing I aspire to do. You'll have to stick around in the show and find out exactly what he does. I'm going to move these lights if that's okay. I'm done with them. But Andy's a cool dude, man. We always have a good talk with him, so.
Yeah. All right, everybody, you are going to enjoy this show. So, hey, before we start, make sure that you're going to save your airline treats. We just got back from a Cabo trip, and we saved all of our United Airlines treats, and I just had one. Ooh, it was a chocolate with little salt chunks on it, and makes me want to be a baker now and use plenty of salts because salts aren't that expensive.
That's what my dad told me too. Salts are not that expensive, but we got the beverage man with the salts. We got the kitchen man. We could easily do a baking show, man. We got beverage and kitchen. But stick around to the Investor Shed podcast with Andy Byrd, Nick Beveridge, and Jeremy Kitchen coming up.
Here it comes. Stick around.
Ladies and gentlemen, welcome to the Investor Shed podcast. I am so excited to introduce our guest today. Before I do, though, I want to point out that 66.6% of the repeating people in this chat are bald and have beards. Ladies and gentlemen, Andy Byrd. Andy, how's it going today?
Doing good, man. Thanks for having me.
Yeah, absolutely. Thanks for making it. Nick, sorry you can't be in our cool bald beard club, but maybe someday you'll get hair loss.
You know what? I just shaved this morning. God, I wish I can go back in time. I would have just shaved my head instead.
well, speaking of going back in time, Andy, thanks so much again for joining us. Before we get really into the nuts and bolts of this thing, can you tell everyone kind of what you do and how you got started in the real estate business?
Yeah, I'm a mortgage lender with Willamette Valley Bank. Got started really when I stopped in the hospitality industry. Used to manage bar at the Coeur D'Alene resort and decided I wasn't getting paid enough for my time and effort, and went and ventured out and took an opportunity in mortgage lending, and so far it's worked out pretty good.
There you go. So that's a weird transition, right? You were a bartender or you ran a bar, and what made you want to be a mortgage lender?
The hospitality industry, I think, is actually similar to the mortgage service side of things, and so when I got into the industry, I went through a process to buy my own house, and I didn't feel like I was educated during the process. And one thing that I've always was big on when I was in bartending was really educating the client if they wanted any information on how do you make this cocktail or whatever the situation was. So I brought my service aspect into lending, and I think it's proved pretty good so far.
Nice. How long you been in the lending industry then?
It'll actually be 10 years with Willamette next month, but 11 years in the lending industry. We were with Goldwater Bank prior to becoming Willamette Valley Bank.
Congratulations on making it over a decade in this industry. That's pretty good.
Pretty cool. I actually was just thinking about it the other day. I'm like, wow, But when I started, I had as much hair as Nick, so I'm not sure if I made the right choice.
Yeah, you're. I've gotten multiple loans with you, and I can't imagine. I can't imagine most clients are like me, and that stressful to deal with. But tell us what is it like in a day of the life of a mortgage lender?
My day kind of starts out cleaning up emails from last night or early this morning, and then kind of moves into what do I have from a loan standpoint of what files need assistance, where are we at with this, who needs to be updated on whatever part of the process. And then from there, it's mostly trying to market to get more loans in, and that's calling past clients, calling referral partners, that kind of stuff, fielding phone calls.
And for the perspective for people out there listening, it's September of 2023. As far as I'm aware, I'm not in your industry, but I'm surrounded by it. And from what I hear, it's been a very difficult year for mortgage officers. They don't really have business being thrown in their face as much as they used to, and you actually have to try at your job. And what I noticed, right when interest rates started skyrocketing, you had started reaching out to me either automatically or intentionally, and I just thought right away, I'm like, okay, I see where the industry's going. I know a lot of lenders are probably going to get out, and Andrew seems like a guy who's not just going to make it, but he'll probably thrive. Tell us what has this last year been like, where business is down in general. I don't know about your business, but business for the mortgage industry, what is it, down 80% or something?
I don't know exact percentage, but definitely we're doing less loans than we were previously. We kind of saw the writing on the wall because that 3%, 2.5, those rates weren't really born to last, right? They were due to what was going on within the entire global market, and a lot of people took advantage of it. But during that time, tons of money was coming in, right? People were spending money, people were refinancing. So I barely had time to spend at home with my family, let alone reach out to past clients. Or so it was just really fielding phone calls all day. We were doing, I was looking back, and I think there was 3 months straight where I did over 30 loans, and that was just insane. And now we're at a point where I'm doing, call it between 6 and 12 a month. And I think that I saw it coming. And so what I really focused on was you can't control what the rate is doing. What you can control is how often you're communicating with those people that may know somebody that needs home loan assistance. And ultimately, I figured that the more people I talk to about the possibility of a mortgage, the more likelihood that I'm going to get somebody that is going to need a home loan. And really, I'm like we talked about before we got on the recording, was my whole goal is to make sure that people can achieve their goals, and that doesn't always have to be with me. And so I've told clients plenty of times, hey, your best interest is not doing a loan with me. Maybe you should go get a home equity line of credit or something that would allow them to still achieve their goals and do so at a more cost effective rate.
And I remember my wife and I, we talked to you actually about DSCR loans, and we were talking about a couple commercial loans as well. And you were very honest with us, and that's something that struck a chord with us. Like, Andy's just a solid, reputable dude. You were even saying like, "Hey, this might not be the best choice for you. Like, we don't have the best products for this, but honestly, like, we want to work with you because we want to work with people we know, like, and trust, right? So no matter what it is, like, we're coming back to you because you've built that for us. So."
I really appreciate that, and that's something that I've always tried to do is make sure that I'm not just, hey, call Andy to get a home loan. I want to make sure that I'm helping people, not just in the home loan industry. And I don't, like I said earlier, I don't tell people that no, you can't get a loan. It's no, you can't get a loan right now, and here's why. And so let's work on these items to put yourself in a position to where you can in the future.
Sure. What problems do you think the average American is having right now, or the average client coming to you is having, either getting approved or getting a down payment, or like what's the holdup for a lot of people right now?
I think the difficult thing right now is loan guidelines have debt to income ratio requirements. And if you was actually watching, there's this kid on YouTube that's a lender in another part of the state that has good content. And so he was talking about the affordability in the I want to say 70s when rates were like 14, 15%. compared to the affordability now. And at that point, your income was 4 times greater than it is today, but the gap between like what your cost of living was is 6 times more expensive now. And so it is more difficult to get a mortgage today than it was when rates were 15, 16%. And that's because your debt to income ratio compared to your income can only stretch so far. And so you average person to be able to qualify for a home compared to what the average person did then, they would have to be making $140,000 as a household. And the income right now per household just isn't there. And so there's only a select group of people that can actually qualify. And what's a crazy statistic is if the rates were to drop 1%, 5 million more people could qualify for a home than could today. And so that plays into it. But really, just the struggle, I would say, is debt to income ratio, because you can only afford to go so high with the payment based on the loan guidelines, which is actually a good thing because we're not going to get ourselves into what happened back in 2008 and 9 when the debt to income ratios and actual income didn't matter.
Hey, so what you just touched on is something not a lot of people talk about. A lot of people like to, older people, they like to, maybe because they haven't really done the math, but they like to preach how, yeah, back in my day, interest rates were 18%. We still made it work. Or yada, yada, yada. But I think what you touched on is pretty critical. Like there's a debt to income gap too with inflation and where prices are today and interest rates combined. And with the amount of income not kind of growing as quickly as inflation has over the last 8 decades. Can we dive a little bit more deeper into that for the people that may have missed that whole concept? Because that's what I think is something that's really pressing that a lot of people just don't understand. And you did do a good job of describing it, but I think we should go a little bit deeper if you don't mind. What kind of income does somebody have to be making today and I know there's a lot of other factors involved, but what kind of income on average does somebody have to be making today to afford and a medium household value?
Yeah, so median household across the nation is somewhere in the low 400s, call it somewhere between 410 and 440. And so to be able to afford that, the average person is going to put 3, 5% down, right? Not everybody can do 20% to avoid the mortgage insurance. And so on, call it a $410,000 loan, you're looking at a rough idea of your payment being somewhere around $3,000 to $3,200 a month. And that's including taxes, insurance, and mortgage insurance. You're going to be plus or minus, call it $250, depending on what part of the country you're at, property taxes, that kind of jazz. But if you're at a, call it $33,000 a month payment, debt to income ratio typically can't exceed 50%. And so that would mean that at minimum, you would have to make $6,000 a month, or call it $72,000 a year. But that's at minimum, and that's assuming you have no other debt. So if you have a $250 car payment, now you have to take that into account. So now you can afford a $2,750 monthly payment on your mortgage. But most people's car payment, average car payment right now, it's an insane statistic. Don't quote me on this. Google it yourself. But it's somewhere between like $500 and $700. And so then if you've got a car payment, you probably have some credit card debts. And so you have to factor all that in when you're talking debt to income ratio. And so the average person, you got to at least make 75,000 at minimum, but most people need to make somewhere in the high 90,000 or so to be able to afford something comfortably, because really you don't want your housing. The general rule of thumb is you don't want that to exceed 33% of your gross income. And so $90,000 would put you right in that range of being at the 33%, assuming that's you're around a $3,000 a month payment.
Yeah. And here's something else I want to add to that for the people that are simply just comparing housing costs today in comparison to 50 years ago. Look at the difference in product that you're getting on a house today versus 50, 60 years ago. Almost everything is more expensive because people's standards have gone way up. Like you get a driveway these days. These days you get a house with a foundation that's, below the frost freeze. You get a nice crawl space with visqueen and it's insulated. Um, or, a basement that's done right, or a slab that's done right. And well, I can keep going and keep going, but all the materials that make up a home these days have such higher standards than they ever used to. So you're paying for that, and people don't realize it. But like, you didn't need a backflow valve back in the 50s.
You didn't need to pay the city every year for it either to test it.
Back in the 50s, the city didn't charge $30,000 in sewer water hookup fees and permits. There's so much that people just aren't considering that they're getting with today's housing product versus 50 years ago. The windows aren't single pane anymore. There's a much better insulation value. I can keep going and keep going and keep going, but it's almost every ingredient that makes up a house. Today, it's way better than it ever used to be, and people are paying for that, but they're not realizing it, or they're not taking that into consideration. They're just complaining about how much more expensive it is today than our grandparents ever had it. But our grandparents, they got what they paid for. They're living in shacks that cost $70,000.
I remember talking to my mom that she bought her first house. It was 32 grand.
Yeah, and it was probably worth 32 grand. And if you were to model exactly the building styles and the ingredients that they used, you probably would be spending double that. But the way homes are built these days is way different from post 80s. The standards have just climbed like crazy, and people just don't. I don't think anybody ever takes that into consideration when they're comparing housing costs today versus decades ago.
Well, just the square footage alone is more, which is going to cause more cost because you used to have bedrooms were what, 8 by 8, 8 by 10, enough for a bed, a couple nightstands, and a small closet. And now most people's closets these days are as big as the bedrooms were back then. And so when you expand the size of the footprint, it's going to cost more money.
Yeah, the average house size was 600 to 900 square feet decades ago, and now it's about 2,000. So you got more than double the product, say space wise as well.
And just alone, you can probably attest for it better than myself or Jeremy. But when you were flipping houses over the last 5 years, if you looked at the cost you were paying in 2018 compared to the cost you're paying now, it's probably insane. Yeah.
It's doubled. Yeah.
Yeah, it's wild. And then obviously to go with that, I think the build quality of the house itself was better earlier on, but nowadays we have more features built into our houses, right? So and the features are the things that drive the cost, and then the cost of the dollar itself is just outrageous anyway. So inflation's weird.
I was out open housing one weekend and just popping into some places, and you go to a couple different builders and you can tell, like, okay, this base price for builder A, you get a base home. But then you go to builder B and you get built-in surround and you get glass bathrooms and such with the showers. And so you pay for what you get, but ultimately you got to decide, does a house make sense for me? And if a house makes sense for you, then I think it's really comes down to, can you get what you want at a price you're comfortable with? And do you like the home? If you can do those two things, then I think it always makes sense to buy the house because house prices, if you look at it, they're undefeated. They're continuing to go up.
If you had some advice to give to anyone trying to get a mortgage, Andy, that's having trouble getting pre-approved or having trouble with their finances, like what kind of goal would you set them on, or what kind of plan would you set them on in order to achieve home ownership?
Everybody's situation is different, so it'd be hard to give like a general answer, but I'd say the first step is to educate yourself in what the process looks like and what you can actually do within your specific situation. Because if you just became self-employed, you're going to have a large down payment because you're not going to be able to qualify for your traditional conventional FHA type of products unless you've been self-employed for 2 years or 1 year in certain situations. And then if you're new to just graduating from college and you have a job offer, then you're in a different position than that other person. And you may need to just pay down your credit cards to see your credit score jump up. Or I had a client the other day who he's a dad who's the only income earner in the house, and he sadly with his car payments and credit card bills just doesn't make enough money to qualify for a $400,000 house. And so the sad advice I had to give to him was you can either try to find a better job, paying job in your industry, or change industries, or you can go to an area in the US where you can make what you're making still, but be able to afford a house because the housing costs are $250,000. So that's the tough thing, is when you have to have those conversations. But I figure be honest with somebody, and then eventually they'll either be able to buy something, or at least they know their stance and what their options are.
Right. And the choices are either, make more money, pay off more debt, like make yourself bankable basically, and get yourself in a position where you can end up buying a house, because once you buy a house, um I just feel like life got easier for me, which is weird, right?
Yeah, I think that there's situations where life gets harder. I've been having well issues at my house, so that makes for some fun. But I think that the position that the a home has put me in today, and the investments that I've made, are going to be key to not only what my future looks like, but also going to help out my kids in the future as well.
Awesome. That's a good segue to that. Nick, did you want to say anything to that?
Yeah, I think we are going to segue into this. I just think, as far as the data I've seen, people that own a home versus tenants, they tend to always have like 10 times the amount of net worth, homeowners versus renters. Like it's been a long time. I remember when I was first getting into real estate, I remember Keller Williams teaching like kind of a stat. And at the time, this was like 12 years ago, but they said that your average homeowner has a net worth of 40 something thousand, and your average tenant has a net worth of something around 6,000.
Yeah, we have I'm actually looking up on another page right now. We have a graphic that we created for this, Nick. I'm going to pull it up. I'll give you a statistic that we pulled off of a website.
So when people say, should I own or rent? It's kind of a no brainer. Like, yeah, you should probably still own, but
If you can, you should.
That's the biggest thing, is that if you can, you should. And how do you make it happen?
If you can, you should, and if you can't, get yourself there 100%.
if you can't get some partners or friends or roommates.
Well, that's actually a great point. And I think that if you can afford to buy a house, or maybe buy a house with somebody, because right now, if you only make $70,000 and you have car payments, you're probably not going to be able to qualify on your own.
Hmm.
But what if you found a good friend or a acquaintance that you know, like, and trust? I think that's the biggest thing.
Right.
That also has the dream of home ownership. And you go buy a 4 bedroom house or a 5 bedroom house together, then you can get a couple of roommates, and you guys can both be in a position where you've reduced your own out of pocket spend, because you have roommates, which is probably going to be cheaper overall. And then somebody else, with those two friends that are living with you, are helping pay down your mortgage. So you're not spending a ton of money out of your own pocket.
Yeah. It's not a common move, but people have done it. One of our last guests, Kyle Greenwood, he bought his first primary residence and partnered with his wife's coworker, and they all made it work.
Yeah, they're probably in a position where eventually they're going to move out of there and turn it into a rental, and then they'll both be bringing in a little bit of cash every month on the equity of the house put together.
It's that house hacking strategy, man. It's good stuff. Are you pulling up that stat, Andy, or no?
I actually just kind of jumped away from it. It looks like that over the first 5 years, owning a home is going to put you at $157,000 in appreciation tax benefits and amortization gain, whereas you're going to be spending on estimate $189,740 going to your landlord.
Okay, let's repeat that again and break it down if you don't mind. What does that mean? 150 something thousand in what?
Yeah, so amortization gain, which would be you paying down your home loan over 5 years.
Okay, so that's the payment that you're making. That's money that's actually going in your pocket, just not. It's just going into the equity of your home.
Yeah, so every payment that you make, obviously a portion goes to pay back the principal or the interest on the loan, but the other portion pays down your mortgage. And so that is equity that you're gaining. And so that's averaged to be right over 26,000
Over 5 years.
over 5 years. Yep. Your tax benefit, 27,700. That's your ability to write off your mortgage interest, and then any other things associated with your home loan, or your home for that matter. And then your appreciation, which is just over time, the average home at 400,000, they estimate that 5 years from now is going to be roughly worth 600,000, which is an appreciation gain of a little over $103,000.
All right. And if you're a tenant, the alternative is you pay your landlord how much?
Yeah, we're putting in the figure estimate to landlord's going to be 189,000, and that's factoring in two things: your average current rental cost, and then it also is factoring in the increase in rent that happens over time. So just because you're paying maybe call it 17, $1,800 today, that doesn't mean that 3 years from now that 17, $1,800 house might be 22, $2,300.
Sure, makes sense.
Now, does a tenant get to write off their rental payments?
They will do not currently have that opportunity. So ideally, the only option you have to write that stuff off right now is mortgage interest.
Okay. So basically, if you're a tenant for 5 years, you're just going to get shit on by everyone in the government and the industry and your neighbors and your landlord forever.
I wouldn't say you're going to get shit on.
Well, right. Yeah, pissed on, shit on, I guess.
Yeah, you have less control over your future because I don't think that you don't always have to own a house. I wouldn't say that renting is a bad idea. If you're not sure where you're going to be in 6 months or 12 months or whatever the situation is, or you're choosing that you maybe want to move to beautiful, wonderful Coeur d'Alene, Idaho. For those that don't know where we're located, worth the Google. But if you're wanting to move here, maybe come here for 6 months and rent, find out where you want to be, and then you can buy a house in the neighborhood you want to be in. But not owning, I think you're just kind of missing out on an opportunity.
Right. And I think the takeaway with that too is have a plan. If you're going to be renting, like have a plan to get out of it, right? Because like you said, like the numbers don't lie on this stuff. Um, the appreciation and the tax benefits that you get just for owning real estate is beyond anything I've ever imagined. But I did want to kind of segue. So we talked a lot about mortgages, Andy. I want to talk about your investments. What kind of things are you investing in? Because I know, again, before the show, I've like every time I talk to Andy, I feel like I get smarter because you're just such a smart, solid dude. What are you investing in? What are you looking to do with this market?
Couple things that I'm looking at investing in, which I haven't yet, but my current investment strategy is mostly opportunity in apartment complexes. I've got a few friends that I grew up with that, or my cousin that we've kind of been buying apartment complexes over the last 6 years. About one every year and a half is what it seems like. And the strategy we use there is kind of like a Burr method, but not as much, in the sense that try to buy something that we see is going to hopefully appreciate in value or an apartment complex that's somewhat mismanaged. One of the guys that is on the investment team there has he manages apartment complexes for others, so it's kind of like a perfect situation, and he can analyze what's going on within the management structure and see if there's an opportunity there. But then we purchase it, and within a year or two, our goal is to refinance out of that with a cash out refi and get our investment back. So then we can in turn use that to buy something else. The downfall is it obviously cuts into your money that you make every month. But the positive is that we still make money every month and we get our money back. So I'd say that's kind of a win all the way across.
So, Andy, do you mind sharing? Are you in these deals? Are you an LP? Are you an LLC member? Are you just a joint venture? How do you set it up?
LLC,
Okay.
yeah, they're all set up as LLCs. As I think that that's kind of the one of the easier routes, and it also protects us all involved in it, and it gives us the ability to change it if necessary because they can be easily edited, assuming all parties agree.
Are you responsible for doing any of the operations?
That's kind of the best thing I like about it is the amount of time that I've spent at them has been driving by because I happen to be in the area. And yeah, just checking on it just because, hey, I own it and it's cool to see it. But yeah, from a standpoint of what I'm doing on a daily basis, I get an email once every other month that says that I got money deposited into my bank account.
Well, at least you are at least driving by and driving by. Hopefully, you're reporting on what you saw, because I from what I just learned at the seminar was that if you're not at least doing that, then you're technically in a syndication. That's probably not set up properly. If you're not doing some form of operations, if you're purely a passive investor, but for the people out there listening, do not take what I'm saying um, to heart. Go talk to your attorneys. But It was very interesting hearing joint venture. A lot of people do joint ventures wrong, and this sounds like it's not a joint venture. You're an owner on an LLC, but it could be similar.
Yeah, my involvement's somewhat minimal, but I still do what I can to help out when needed.
Sure. And the way you guys have this structured, Andy, so obviously, are you coming in as a capital partner on these situations? Or are you helping finding deals?
I don't do much on the deal finding. It's more on the capital. So percentage ownership is really what it comes down to, and it's we really just split it based on what we have to put down and closing costs, and then we divide that number by whatever the amount of investors is, which most of them I think we have four, and then there's a couple that we have six, which just because the purchase price was out of reach for everybody at that specific time, so we brought in a couple extra people.
Gotcha. And the next question I have on that, so obviously you being a capital partner, when you refi, are you still in ownership, or are you getting cashed out on your ownership and then looking to pull it in something else, or are you still an owner on those properties?
That's the thing that I love about it is the ownership remains the same percentage. We just get our capital back.
I like that.
Do you want to share with everybody your best deal ever and some of the details?
The best deal ever I should never sold.
Tell us about it.
So I I bought a property here in town, which actually we talked about at one point. It's about whether or not I should sell it, and I probably should have listened to you. So thank you for the good advice, Nick. Sorry I did not take it.
Nobody, it's okay. I'm used to it.
You can lead a horse to water, man.
Can't make him drink. Yep. So I bought a 3 bed, 2 bath home just north of Coeur d'Alene, and it's on 7 acres right outside of one of the cities, or just shy of seven. Yeah, and I was able to put a little bit of money into it. I ended up spending somewhere in the range of 25,000. But after sale, I was able to make close to six figures on it. It was a pretty good win. And then the person that bought it was kind of, oh, she won as well because there was $30,000 in equity when she closed as well. So it was a win all the way across for start to finish. But the downfall was the value of that property today is significantly more. I was offered 75, 80,000 after 2 months after selling it from another party. And I've got numerous phone calls. Hey, do you still own this house at this address? Because there's not a lot of people that own that size of acreage that close to town. So there's a ton of opportunity there that I missed out on. But I will say that I took the proceeds from that, bought an apartment complex in another part of the U.S., and that's so far doing pretty well. Just got the first check on that as it took 7, 8 months to close, which was annoying, but whatever.
Yeah, commercial deals are a little different than residential ones. So
That deal that you regret selling, how did you find that deal?
Opportunity from a real estate agent. There was a deal that was going on where buyer was in a rent-to-own situation, so the seller had got out of it, and he had already moved on with his life, purchased another house, and was already out of the area, and the rent-to-own situation fell apart. And I was able to got a phone call from the realtor, and he's like, "Hey, I got this potential opportunity." They'd take it over at the same terms, which were terms from a year prior because it was a rent-to-own situation. So I was able to come into a little bit of equity, do some repair work to the house that was needed, and then make a couple bucks.
Gotcha. Did you actually go do the repairs yourself, or did you hire it out?
I did a. I have soft hands from working behind the desk, so I can clean stuff up, but I can't put it back together. So I went in, cleaned the house out, removed a couple things that were not needed to be there, and then had a small crew of people do some updates for the house for me.
Very nice. Okay, so classic fix and flip.
Yeah, yeah, it worked out pretty well. And not a ton of opportunities like that right now in our area, but that goes to the other part of your question was what am I looking to do? And there's some markets where you can buy homes for 50 to $100,000 that need $10 to $20,000 in work, and so my plan is to take a trip over the next year or two and see if I can develop a team of people that can help out with that and do it on a much smaller scale, where I'm 10, 15,000 at a time with the ability to put back in do cash out refi, get my investment back, and then turn around and pencil $200-300 a month. But you do 10 or 12 of those, you're going to be in a pretty good position.
Oh yeah. Even like if the average American, I can't remember the statistic on it, but if the average American had 5 rental houses and did nothing else for the rest of their life, like that, those rentals being paid down and that cash flow would substitute for anything else that you needed to do in life. That would make you a multimillionaire at that point, right?
Yeah, we had the house hacker meet. Yeah, it's all in timing, right? Well, that house hacker meetup where Robert came in is the perfect example of that. He has 4 houses that now down to 3, where he's in a position where with his retirement income and the extra money he's got from his rentals, he gets to play on his boat and ride around on his bike and jump into his plane and kind of do whatever he wants every day.
Yeah. That was a cool speaker you guys had for sure. I enjoyed listening to him. Just a couple other things on your investments, Andy. So obviously, when you're a partner in these things, I want to kind of dive into your partnerships and how you found those, because it sounds like what you guys are doing works really well for all parties involved. How did you guys all come together and form this partnership? And did everyone have specific roles when you made that partnership?
Kind of. One of the guys is a lawyer, which works out really well from a legal standpoint and just structure of LLCs and such. One of the guys, like I mentioned, is a property manager. So he probably does most of the legwork, but he also gets paid the most because he gets his property management percentage every month. And then we get paid after that. And then the other two in our main group is we're mostly capital investors, and that would be myself and my cousin. And kind of where we help out though is we're both on the finance side of things. So we understand kind of well where finances are going and what we should be doing with that side of things. So kind of helps out pretty good team all together. Everybody's got a little bit of a added piece that we can put in that the other guys don't have.
Have you ever thought about bringing in other capital partners?
Yeah, like I said, we had 2 that we brought in other people, and that was more just because we weren't in a capital position to be able to do it all ourselves, and also the total purchase price was just the down payment was insane. I was also in the middle of remodeling my house, so I was low on cash. So I'm like a 5.8% in that one, whereas most of the guys in that one are 12, 15% or more.
You know what 5.8% is better than?
0.0.
Exactly. Yeah, yeah. So I think that's awesome. Anything you want to add to that, Nick?
Yeah, so you mentioned a house hacker meetup at the start of this. Can you tell us a little bit about like how'd you get that going and what that's like, and can you share a little bit about that ongoing meetup that you put on?
Yeah, so I was a lot of people that are probably listening to this have probably heard of Bigger Pockets, and I was doing my job one day, and I got a call from Craig Kierlop, who's on Bigger Pockets, and he kind of has been all about financial freedom and house hacking. And so we did a loan for him to purchase his house here in North Idaho. And then once he moved up here, got his license, and we sat down for lunch one day and kind of talked about what his goals and plans were. And one thing he had success with in Denver was his house hacker meetup. And so we have our space actually that I'm in right now here at the lounge. Fourth Tuesday of every month, we get together, have a little hour of kind of call it a cocktail mixture, if you will, beer, wine, snack, and then just kind of network. And then we get into an hour presentation on something in regards to real estate investing and how you can help yourself to achieve financial freedom through real estate. Pretty good event.
And how long you been doing that now?
We just had our ninth meetup, so been pretty good. I think this last one we had the most turnout, if my numbers are correct. I think we were at about 18, 20 people. Yeah, we're probably going to get in, I think, in the next 6 to 12 months, if we continue to grow at this very slow pace of 2 or 3 extra people a week, we'll be out of this space and have to find something a little bit bigger.
It's not a bad problem to have.
Yeah, one of the best problems is growth, right? It's worked out well from a lending standpoint, and it's something that you can't stop. There's going to continue to be more people that come into this world, which means that we're going to have to continue to grow and get bigger.
Sure. Going back to your investments just a little bit, Andy. So obviously, what you've done is it's a very particular thing for your group, right? But if anybody wanted to start something like what you're doing, how much capital do you think they would need to get started for, a deal or two?
It depends on the size of the complex. Your average, I think that the tough thing is if I was to say for this specific type of thing, you're probably going to need 50,000 or more. If you're looking at just getting into investing, I think you can do that with less. And that would be more on the house hacking side of things where you can buy a house with a 0.5% down in the right areas or sometimes 0% down. So I think that if somebody's looking into getting into like your commercial investing, you're going to need a little bit of capital. 50,000 is probably a minimum, but good to have six figures or so.
Hey, so can we transition a little bit and talk about the mortgage industry a little bit more and maybe rates and the Fed? I know it's probably not your favorite topic right now, but I would like to mention, I myself included, a lot of people have made predictions about a year ago that we would definitely see rates come down this year, and we were pushing, basically based off the information that we had, 2-1 buy downs and those kind of programs. I haven't seen as much of a push for it lately. Maybe I'm just not seeing it, and it's out there quite a bit. But can you talk to us about why everybody, including myself, was so wrong about what happened with interest rates? And even though inflation came down, rates did not. Do you have any perspective on what's happening?
The Fed has a target goal, and I think that they are reacting to the data as it comes out and not as it will continue to come out. Because if you look at inflation over the last 9 months, we've continued to see drops in inflation. And so they've continued to raise interest rates, which obviously has impacted that drop in inflation. But at what point do you stop? Because if you're going on a trajectory like this, and now we're obviously on a trajectory like this, eventually it continues to go. And so you want it to level out. And so when do you start to taper back? And I think the Fed's been kind of wrong with that tapering back, as I think that we probably should see rates a little bit lower today than they are, but ultimately we're not the ones making the decisions. So we kind of have to roll with what's going on there. But I do think that we're on that cusp where we start to see things go the other way because of what the last 9 months has shown.
Just out of curiosity, how much could somebody potentially get in a credit? I guess it depends on the loan program, to have their interest rate just bought down. Not a 2-1 buy down program or anything, but if somebody just is fixated on the idea of I just want a lower rate, I just want a lower rate, and I'm working with a seller that's willing to credit me as much as possible. Can you give us an example of what's possible?
Yeah, so you can buy the rate down as far as the seller's willing to because a seller credit is not a item that has to meet within guideline, or sorry, I should rephrase that. Uh, the seller credit is something that if a seller is willing to pay 4% towards a rate buy down, which is going to likely result in somewhere around a 1.5 to 2% lower rate for the individual, then it can be applied. Because typically, though, if that buyer was going to do that on their own, they're limited to only being able to buy their rate down by somewhere between 2 and 2.5 points, depending on the loan amount. And that's because of high price mortgage loan guidelines. But if the seller's paying that, it's not involved in that high price mortgage loan type of scenario. So therefore, you'd see the rate go from, call it 7%, 7.25% today. You'd probably see that come down to 5.25, with the seller willing to pay 4% in seller credit. But technically, they're maxed out at 6% on most loan programs. But if you're putting 25% or more down, conventional allow you to do up to a 9% seller credit, which is insane. But I think that the temporary buy downs are making it back, though. I'd say on the probably 30% of my loans have some sort of a 2-1 or 3-1 buy down right now. A lot of those are with new construction builders who are enticing their clients or their consumers to purchase houses and willing to offer credits to do so.
Yeah, I've seen a lot of sellers lately completely willing to offer credits just to be first in line to sell their house because there's quite a line stacking up of people waiting for qualified buyers.
Well, what's funny is 2 years ago we were offering 50, $100,000 over asking price and waiving appraisals, and it was no problem. And that's what caused us for the values to increase as they did, right? But you look at the other flip side of the coin where we're at right now, and now the sellers are giving concessions to be able to sell their house. And so what I would tell a buyer right now is if you can get a house with a temporary buy down where you can get a 3%, 2%, 1% lower rate for a period of time, consider it, because ultimately in a year or two from now, if rates are 5.25 or 5.5, the market's going to be a little bit more balanced. You're probably not going to get that opportunity at that time.
No, makes sense. It's a wild world of mortgage rates for sure. So, props to you for sticking through it, man. You're a good resource as always. And yeah, Nick, do you have anything else before we kind of get into the wind down of the show?
Well, it's just I it's hopefully people are taking this home though. Like Andrew's made the smart choice of investing his money that he's made. You've been a lender for a decade, and I can't imagine not every lender that you work with is actually spending their money on apartment buildings, and not just boats. Uh, so I think it's the lenders that bought nothing but boats and trucks over the last decade when things were really hot, and now they have to survive on the income that they can make today. And fortunately, I'm sure you're not in that place where even though you're still doing well, because you've invested your money wisely over the last few years, it's not as prudent for you to make the same kind of money that you were a few years ago just to pay the bills, right?
Yeah, I do what I tell my clients, and that's find a budget, find a comfort, and live within that. And so I know that what I have to make every month is to make my payments, pay my bills, live my lifestyle style is less than what I typically make every month. And the reason I do that is because I've set myself up where I love my job. I enjoy the heck out of it. But do I want to do it until I'm 65? I really prefer not to. So I'm trying to do what I can to put myself into a position where I can retire early and hopefully spend a lot more time with my wife and my family.
You don't want to be the constant middleman between an upset client and an underwriter, and when you're in your 60s, making the back and forth phone calls, asking for an
No,
update.
I would rather not be, and I try not to get upset clients in between the underwriter, but obviously, there's situations that we can't avoid that, and ultimately, it's just get out there and try to do the best thing. And if I'm taking care of my client like I expect somebody would take care of me, most of the time it works out pretty well.
Maybe not upset clients, but over emotional. Over emotional and time stressed.
We're all in the business of real estate, and it's not just the business of real estate. We have to be there to be able to decompress people's stress, because really buying a house is a very stressful, heightened emotional time for you. And the craziest thing is you got your normal life, but then you have to squeeze in kind of what feels like a full time job at times, buying a house. So I do my best to understand that and try to take as good a care of people and be available, because I know that if they're off work at 9 to 5, I might need to answer my phone at 5:30, 6 o'clock at night to be able to help them with their questions so that we can continue on the same path to be able to close a smooth transaction, which most of the time works out. Sometimes we're kind of tripping over the finish line.
It's how it works sometimes, but you're get there eventually. So, well, cool. We're gonna get down to our wind down questions if that's okay with you, Nick. I know Andy's got to go play kickball right now, so we gotta get him on the road here in a minute. Andy, first off, I wanted to say thank you just for joining us today. Like, just your knowledge and your background, it's always good to talk to you. You're just a solid dude to be in business with, and it's really cool to have you on here. So thank you for that.
Thanks for having me. I really appreciate it.
Yeah, absolutely. Like I said, so we're going to do a couple predetermined questions at the end. The first one is if you have one business or investing book that you recommend all investors read, what would that be?
I got a good friend who wrote a book, Craig Kierlop. I would
Mhm.
encourage taking a look at his house hacking strategies. You can find it on Audible for 5.95, but
Ooh.
100% worth the read. Really different way to look at investing, so I'd say it's worthwhile.
I will absolutely agree with you, Andy. I read that book. It takes investing and it shows you exactly how to do it easy without all the gimmicks. It's like buy a house, put renters in there. Once your renters are in there, you buy another house because your house appraises, and you just go. And it's the easiest way, I think, to get started in real estate investing with house hacking. So shout out to Craig Kierlop for sure. Next question is if you were given $30 million or gifted it to one of your bank accounts, what's the first thing you'd spend it on?
I would start by paying off my mortgage, but then I would look at investment opportunities. The coolest thing about having money is you can multiply it. So I'd look at different markets where I can not just make a profit, but actually make a difference. So I would do that and find out some way to create some sort of a philanthropical piece. Because if you have $30 million, you have probably 28 million more than most people are ever going to need. So how can you use that money to do good as well?
I love that. Not just for profit, but for to make a difference. That was a very good takeaway. Very good. What advice would you give to new investors, Andy, who are looking for their first or second deal?
Don't overthink it. Um, do the work, the diligent piece of it, but don't spend too much time to where you miss out on the opportunity. There's been times where I've overthought a deal, and because of overthinking it, you miss out on it. So put your foot in the or put your toe in the water, but be ready to jump in when you feel like it makes sense for you, and don't overthink it.
I love that. Next question for you. How do you define success?
I think that success is defined by me. I'd say having that opportunity to just feel free from whatever it is that stresses you out. So I'd say success is being stress free. Stress free.
I like that. And then when you're not investing or you're not making mortgages for people, what do you like to do in your free time?
I'm about to go play kickball, which sounds childish, but I like to play sports, go hiking with my family. My daughters are both involved in volleyball, so weekends and a lot of times are spent sitting outside of the basketball court watching the volleyball go back and forth.
You got a mean layup too.
I got an okay layup. Sometimes it rolls in.
I will say, I was like I say, we do actually play basketball with Andy every now and then, and we play with Craig Kurlop, which is kind of cool. But Andy came by and he graced us with his presence. The dude's got moves, okay? So Nick and I are the worst two in the room, and I love that. But it's always nice to play with people who are better than you and learn from you guys, and we create a cool little community in there too. So last question for you, Andy, is where can people find out more about you?
You can check me out on Instagram at andy.homeloans. You can also find me on willamettvalleybank.com website, or you can stop by 704 East Sherman Avenue. But I'm available, so if you have home loan related questions or just want to talk strategies, don't hesitate to reach out. I'd be happy to be of service if I can.
And then I have one more plug for you, Andy. So obviously you do your house hacker meetup with Craig Kurlop. You also do a first-time homeowners class. Is that correct?
Yeah.
Yeah. What day is that on the month?
Kind of rotates. We typically try to do it quarterly or biannually, depending on the amount of people that are interested in attending. So the date would be to be determined, but I think we have one coming up in early December before the holidays kick off. And then we'll probably do another one sometime between March and April.
Beautiful. Well, perfect. Well, Andy, hey man, we appreciate your time today. Nick, take us away.
I will. Thank you. All right, everybody. You've heard it here. If you need a home loan, please get in touch with Andy. If you need a hard money loan on an investment property, please get in touch with Jeremy. And before you get in touch with either of those knuckleheads, you better call me first because I'm your agent. Thanks, everybody. See you next week.
Thank you so much for checking out the Investor Shed podcast. If you enjoyed your time, make sure to leave a 5-star rating and review on Apple Podcasts and Spotify. Follow along on YouTube, TikTok, and Instagram at The Investor Shed for shorts and promos about each episode. Do you want to be a guest or know someone who has great real estate investing advice and stories? Reach out to us at theinvestorshed@gmail.com.